Hi, so welcome to the stream today. Really excited for having you on the stream as we continue with our discussion for the. Sorry for the lot of backup here. Welcome to the stream as we continue with our discussion for the March 2023 examination. I believe that you've been studying hard and we are in the sixth week. So technically, we have about 3 weeks to go for the March 2023 examination. And by now, it means that you would have been able to cover about give and take 60-70% of the syllabus and focusing on the key topics that you need to understand in order to position yourself to pass the examination in that particular case. So it's a live Q&A session that I'm doing today on the IFRS and the accounting standards or any other thing that you would want me to share my thought on. So if there are any questions you have, I see some of you joining, you are welcome to the stream. Give us a thumbs up on the video, share the video. Let's reach as many students as possible watching the stream. But most importantly, let me hear from you in the chat. Let me hear from you. What questions do you have for me? What are the things you would want me to share my thought on? Something that you would want me to talk about? Put it in the comment section for me. I'll be reading all your comments and also providing you with some answers real quick as we continue with our discussion. And I believe that you've been studying well for the March 2023 examination. Like I say always, it is important you assess yourself and identify if it is something that you are capable of doing. If it is not something you are capable of doing, there is no need for you to go in the March. You'll be better to go in the July 2023 examination. So, a couple of few things we want to really share our thoughts on today. Like I said, I'm going to be sharing some thoughts on the accounting standards and also provide you with some answers in relation to any questions that you have for me. So, I see some of you guys joining. You are welcome. In the comment section, whatever questions you have for me on the accounting standards, hit me with them and I'm going to be providing you with some answers and also give you some guidelines on some key issues that you have to pay attention to as you prepare yourself to go into the examination writing whatever subject it is that you are writing. I'm seeing some chats coming up. I'm going to be taking them real quick. I want to just structure my slide up here so that I'll be able to take the questions in as we continue with the discussion today. Okay, so let's see, seeing some charts here. What do I have? Eliezer Akufu said, this year, died dear A. It's my first time and I'm writing PSAF and FR, but try. Not easy. Oh. Eliezer, why is it not easy? It's your first time you are writing. So it means you are writing in the March 2023 examination, I guess. And what are you finding difficult with PSA and FR? Because in my opinion, PSA and FR, I mean, there are a couple of key issues that you need to pay attention to and know about to be able to position yourself to ultimately pass the examination. I don't think public sector must be a very difficult subject. Neither do I think financial reporting is also difficult. The reason is that when it comes to subjects like public sector accounting and finance, like we know exactly what the examiner is going to be bringing in the exam hall in relation to the question location and the areas of the syllabus that the examiner would want to be covering. Like question one is going to be on conceptual framework for general purpose financial statements, giving reference to some of the issues in relation to the IPSAS. And that is a reading area looking at the qualitative characteristics of financial statements, looking at the measurement basis in financial statements, looking at the accounting techniques, vote accounting, fund accounting, commitment accounting, environmental accounting, and all those guys. And then accounting basis, which is the accrual basis of accounting, cash basis of accounting, modified cash, modified accrual basis. These are going to be issues that the examiner will be bringing you up to speed with in relation to some IPSAS as well in the question one for the 20 mark area. So like I said, in my opinion, I think that like if you understand it that way, question two is generally going to be issues relating to the financial statement preparation. And it is important you understand the way financial statements are prepared generally. The reason is that the examiner can bring a question in financial statement for the consolidated fund or financial statement for a covered entity. That means it could be a government hospital, it can be a public transportation company, it could be a department, it could be a municipal, a metropolitan, or a district assembly. depending on what the examiner is excited about. But most importantly, one of the key topics that you must understand in relation to the financial statement preparation will be the issue relating to revenue management and expenditure control, because that topic is going to be telling you how to know about the various sources of revenue to the central government that is on the consolidated fund, and also to the other covered entities, being it the metropolitan municipal industrial assemblies, being it an agency or other state institutions. So you'll be able to know their sources of revenue to them in the various classes. Then also you will know the issue about their expenditures. So under the topic revenue management and expenditure control, you are afforded the luxury to be able to understand these things very well. Then the second key thing to help you to deal with financial statement preparation, which is the question two aspect, is going to be the issue relating to the IPSAs. There are fundamental IPSAs that, whether you like it or not, will be present in the exam hall when it comes to dealing with the financial statement preparation. The first one certainly is going to be the IPSAs relating to revenue. So when it comes to revenue recognition in public sector, there are two IPSAs that guides us or provides us guidelines on how revenue is supposed to be recognized. So we have the IPSAS 9, revenue from non-exchange transaction. No, let me take that again. IPSAS 9, that is revenue from exchange transaction, and IPSAS 23, revenue from non-exchange transaction. So these IPSAS will tell us the way various types of revenues like tax revenue, non-tax revenue, grants, donations, and all that will be accounted for in the financial statements of the entity in question. Then we're going to go to IPSAS 12, that is inventories, because if it is an entity, definitely it may have some form of inventories. And it is important you understand IPSAS 12, the way we value inventories that are purchased for distribution at a nominal fee or at for free. And then we have to also take care of inventories that are used by the entity in the general activities of the organization. Then number three, inventories that the entity buy to resell. At the end of the day, the way these inventories are accounted for will also be different generally at the end of the day. Then we come to IPSAS 17, that is property, plant, and equipment, because it's going to be featuring there in that particular case, and you have to understand the way these things are dealt with. So that is question two, financial statement preparation. You got to understand these things very well to position yourself to be able to pass the examination. You come to question three, which is where we're going to be looking at the PIFA and then evaluation of financial statements. So when it comes to evaluation of financial statement, there are three issues there, one of which the examiner is going to be bringing in the exam hall. The first one is the common size analysis. The second one is the ratio analysis. And the third one is the budget variance analysis, with PIFA coming in at the end of the day to help you to understand. And that is question three. Then you come to question four. That is where you're going to have public-private partnership arrangements with public procurement. 10 marks coming in from there. Then question five is going to be a no man's land area generally, where we are going to be coming in from, where the examiner is going to be coming in from various other aspects of the syllabus generally to help you to understand. So the other topics in the syllabus, like public sector budgeting, roles of key public officers, the role of the Minister of Finance, the role of the Auditor General, the role of the Controller and Accountant General, the role of principal account holders, principal spending officers, charts of accounts, gift all of those things are going to be areas that the examiner can dive you in the question five session of the syllabus or of the exam that you need to be mindful of when it comes to the examination. So basically, in my opinion, public sector is an interesting area because once you understand these breakdowns, it means that ultimately you can position yourself and then structure yourself that way to be able to pass the examination. And that is exactly one thing I do here with my students. And because so when we are doing something, I'm like, hey, this is what is going to come in this question. It's there waiting for you. You got to know it. All right, and that increases your attentiveness and or your attention level and your ability to be able to understand it well. So that is the public sector aspect. With financial reporting also, we know the things that are going to be there generally. Number one, the examiner is going to be bringing the ratios, so there's going to be evaluation of financial statements in the exam hall. The most important thing you have to understand is your ability to be able to calculate the ratios but also interpret the ratios very well. That is very crucial, so it is important you understand that very well. The second thing that is obvious going to be there, it's about the accounting standards. So you have to be strong in the accounting standards. And I'm going to be sharing some thoughts on the accounting standards. I see some of you guys joining. You are welcome. Put in the chat box whatever accounting standard it is. Give me something specific about the standard that you would want me to provide more clarity on, to help you to be able to understand it. Put it in the chat, put it in the comment section for me, and I'm going to be answering them for you. So the accounting standards, that is 40%, because we're going to get a dedicated 20-mark question on the standard. Then we're going to get single entity financial statement. That is, it could be a cash flow statement, it could be statement of profit or loss or OCI, and then statement of financial position. So one of these guys will be present in the exam hall, and that circles around a 40% of the accounting standards. So to be able to pass the financial reporting examination, ultimately, it means that you need to be strong when it comes to dealing with the accounting standards to increase your chances of, positioning yourself to ultimately pass the examination. Then once we are done with the accounting standards, the single entity, the ratios, then we come to the introductory aspect, and that is conceptual framework for general purpose financial statements, issues about ethics. Ethics, it's not always that the examiner is excited about it, because there has been two, I think, examination diets where the examiner did not bring any question on ethics, I think last semester and also another semester previously. So it's not something that the examiner will always be excited about, but it is important you know about ethics, how to answer ethics questions, so that if you go to the exam hall and the examiner showers you a blessing of 6, 7, or 8-mark question on ethics, why not you pick it up and then boom, you go away to position you to pass the examination. Then the last thing I would want you to, spend some time on will be the consolidated financial statement. It is crucial you design your study in such a manner that you'll be able to cover the 80% portion and then spend the rest of your time looking at the consolidated financial statement. What I see a lot of students doing financial reporting and corporate reporting is that they spend time really on the consolidated financial statement. I don't know who propagated the lie in relation to the fact that financial reporting, it's about consolidated financial statements. Corporate reporting is about consolidated financial statement. If you know console, it means you will pass. No, you will equally fail the exams, because in the chief examiner's report over the years, what the chief examiner has raised concern on is that students are able to efficiently answer the question one, which is on consolidated financial statement, but the pass mark has always been below the threshold. So it has always been below, because students spend significant portion of the 3 hours trying to answer the question one, which is on the consolidated financial statement. What you want to do is to flip the script. I mean, make sure you understand the various aspects of the syllabus, spend enough time to understand that 80% portion, and let consolidated financial statements be your last but one question that you're going to be attempting in the exam hall to position you to pass the examination. So Eliezer Akufo, in my opinion, I think that public sector accounting and financial reporting, if you understand it in the manner that I've illustrated to you in the last few minutes, you will be able to then study it, and it becomes easier for you at the end of the day. And I believe that you are attending lectures because the way you are sounding in your choice of your words, I believe you are attending lectures. You're not doing this on your own. Like I say always, it is crucial for you to attend lectures rather than sitting down and trying as much as possible to do this on your own. So if you attend lectures, your lecturer or the tuition center will be able to provide you with the guidelines as I've just given you, and you'll be able to go through the programs, do assignments, do performance evaluation tests, do mock examination if something like that is available at that tuition center, and then boom, ultimately you'll be able to pass the examination. So I believe you are attending lectures, and if you are, the journey will be much easier for you at the end of the day, because I mean, that's the ultimate goal. So Eliezer Akufol, that's what I would suggest to you. It's easy, okay? It's easy to pass public sector at once, at a first sitting. It's easy to pass financial reporting at a first sitting. If you have the right environment, the right mentorship, the right guideline, you will be able to go in there and pass the examination. And that's one of the challenges of students, because people have written the papers over and over again, certain papers over and over again, and they think it is difficult, but it is not difficult. It is the way you are guided, the way you are taught, and the way you really put yourself in the course that will increase your chances of passing the examination. I've had the opportunity to, disallow people from participating in our assignment, performance evaluation test, and all that if they don't participate. And this is part of our policy directly on our website. So you are supposed to know that and read that even before you enroll in our program, because we are not just here for the money. We are here for impact and assessing people or enabling people to really achieve their goals and become successful. So one thing that I hold my students accountable for always is, if we give assignment and you don't do it, forget about it. You're not going to join the lectures to discuss that particular assignment. And going into the future, you will not even get access to the lecture videos. And we are working on that as well, because we have to let students understand that you must work to pass the exams. Because some of you will think that the mere fact that, oh, you attend intervention class and then whoever the heck it is that is teaching, Nhyira Premium, whatever it is, whoever is teaching, you think that, oh, as they are teaching, as they are solving the question, no, you don't know anything. You have to sit down, study on your own, and make sure you position yourself to be able to pass the examination. So that's what I would say there in that case. Any other questions, please put it in the chat for me. Something in relation to a specific accounting standard that you would want me to share my thoughts on, you put it in the chat for me, and I'm going to provide you with some understanding and some recommendation there as we continue with the discussion. Kwabena Amponsa, Eshon, Idrisa Bangura, Nana Kwame, Raymond, thank you guys for the thumbs up on Facebook. Really appreciate that. And those of you with the thumbs up for us on YouTube, thank you very much. Really appreciate that. But most importantly, I want to hear from you guys. So put it in the comment section for me, any questions you have and something you would want me to share my thoughts on. What else do we have? Matthew Jeremiah said, can I have access to the video after the live stream? Yeah, definitely. It's available on YouTube, so you'll be able to get access to it. Michael Nkrumah said, IAS 2, I need more, IAS 12, I need more explanation. What exactly do you need on IAS 12 income tax? I mean, what exactly do you need on be specific, all right? Provide me with something specific, because if it's IAS 12, you've not said anything, so be specific. If you say you need more explanation, what's in IAS 12 is your headache? Gotta be specific, because IAS 12 is income tax. It's a broad, or it's a broader, how do we call it? It's a broader standard. So what is it there that is really your problem? Maybe be specific, and then I can provide you with some answers there. Richard Mapuranga said, hi, sir. I'm Richard, watching from Zimbabwe. Thank you, Richard, for joining us on the stream today. Protocol Boy said, hello, Nhyira. I must admit you are doing so well for us. Great, man. Please, when will you touch on advanced taxation and advanced audit? I need some guidelines, please. Basically, we schedule our live stream based on the kind of topics and engagements that we have in relation to video. So really, if we haven't touched on anything relating to taxation and auditing, it means that we have not really received attention for these subjects. So that is why we have not been able to share some things on them. But you can be specific, put in the chat or put in the comment section for me what exactly you would want me to, share my thought on in relation to advanced taxation and advanced auditing, the specific issue. Precious Akpene said, please, can you share your thoughts on IFRS 16? Again, what exactly do you mean? Give me something specific. If you're asking the question, make it specific so that I can meet you. But if you just give me a generic thing like that, I'll struggle to understand what you're saying. Hello, sir. Can you look into deferred tax? Right. So that is more specific in IAS 12. Let's see if I can bring up my slide. Now, when it comes to IAS 12, that is income tax, this is one of the fundamental standards you must understand as a financial reporting student, because whether I like it or not, there is something that will come in the exam or relating to IAS 12, whether I like it or not. If you are doing corporate reporting, IAS 12 is also crucial for you, because you will need IAS 12 to be able to do some other standards like IFRS 2 share-based payments. So it is important you understand the way these standards are netted together generally. Now, deferred tax. Deferred tax is simply the determination of the future tax consequences of a transaction. Okay, so if we have an asset, we've bought an asset, what is the tax consequences of it in the future? That is the idea about deferred tax. Now, usually, deferred tax has to do with the difference between how the entity is carrying a transaction, so the carrying amount of a transaction, and the tax base of a transaction. Now, as you know already, oh, okay, yeah, as you know already, the tax base is simply the amount attributable to an item for tax purposes. Okay, amount attributable to an item for tax purposes. Amount attributable to an item for tax purposes. Amounts attributable to an item for tax purposes. In other words, how the item is kept in the books of the Ghana Revenue Authority, okay, in the books of the tax authority. In the books of the tax authority. So, how does the tax authority see this transaction? How much are they carrying this transaction at? That is the idea about the tax base. The carrying amount, on the other hand, is how the transaction is being carried in the books of the entity. Okay, how the transaction is being carried in the books of the entity. So, comparing the two is going to give us the deferred tax. But before we get to the deferred tax, this is what happens. We're first going to get what we call the temporary difference. The temporary difference is simply the difference between the carrying amount of the item in question and the tax base of the item. That is what we call the temporary difference, TD. The temporary difference. So, how we are carrying the item in our books as compared to how the tax authority sees that same item, it's giving us what we call the temporary difference. One thing that you must understand very important is that temporary difference can either be taxable or deductible. So we have taxable temporary difference and then deductible temporary difference. When we say temporary difference is taxable, what it simply means is that the carrying amount of the item is greater than the tax base. In other words, the entity is carrying the item at a figure higher than how the tax authority sees the same item. What does that mean generally? It means that taxable temporary difference results into what we call deferred tax liability. Okay, it results into a deferred tax liability. Now, deductible temporary difference means deductible temporary difference. It means that here the tax authority is carrying the item at a higher figure than the entity is carrying in its books. So here our carrying value is less than the tax base. Hence, it results into what we call a deferred tax asset, which is usually a position an entity would want to be at always. I mean, having a deferred tax asset so that we can write it off against the profits of the company for the period under review. So the temporary difference can be taxable, it can be deductible generally at the end of the day. Usually, if it is taxable, it means that it's a positive figure coming in. If it is deductible, then it's a negative figure coming in at the end of the day. Now, what does this mean in reality when we look at this? So, let me give you an example here. So, let's say that an entity buys an asset, okay? So, an entity buys an asset. Let's give an example here. So, an entity buys an asset at a cost of whatever, let's say $10,000, and they have decided to depreciate the asset over the useful life of the asset. So economic useful life is 10 years. Now, for tax purposes, the tax authority can grant capital allowance at maybe 25% reducing balance. The idea about fixed assets generally is that whilst the entity is depreciating, the tax authority does not know depreciation. The tax authority disallows depreciation, but rather gives capital allowance. So the entity will be charging depreciation as per IAS 16, property, plant, and equipment. Okay, property, plant, and equipment. But the tax authority will be looking at that same item from the perspective of the tax laws. And the tax laws doesn't have depreciation. What a tax law gives or provides is capital allowance. So if this is what we have, remember our concept here. We said we're going to be comparing the carrying amount of the item to the tax base of the item, that is the amount attributable to the item for tax purposes. So coming in from that angle, I'm going to work for 2 years so that we can also work for movement in deferred tax and see how it is going to be accounted for generally. So let's say we bring in the cost of the assets. And in the context of our example, it's 10 years. Then we're going to bring in depreciation for year one. So that's 10,000 over 10 years. So that's going to be 1,000. So we get a carrying amount or the carrying value at the end of year one, and that's $9,000. Let's do one more because I need 2 years to be able to illustrate deferred tax well. In year two, we'll charge the same depreciation of 1,000 because depreciation is on a straight line basis. So the carrying amount at the end of year two is now 8,000. So this is the carrying amount applying IAS 16, property, plant, and equipment. But immediately in a question, you see that there is capital allowance issues coming in. It means we cannot end here. It means there is a tax implication on the transaction that we have to take into consideration and pay attention to generally at the end of the day. So let's calculate the tax base of the asset. In other words, how the tax authority will see the same item year on year. So bring the cost of the asset, still $10,000, but this time around we will less capital allowance because the tax authority doesn't know depreciation. So the capital allowance, it's 25%, reducing balance basis, and that's 2,500. So the tax base at the end of year one, it's going to be 7,500. All right, then we go to the capital allowance for year two. Go to capital allowance for year two. And reducing balance basis. So we'll take 25% on the 7,500. Let's see how much we have. I see some of you guys joining. You're welcome. Give us a thumbs up on the video if you're getting some value. Share with others as well. Let's reach as many students as possible. But most importantly, let me hear from you in the comment section. Any questions you have for me, something you want me to share my thought on here. So our tax base in year two, it's now going to be 5625. All right, 5625. So this is the carrying amount. This is the tax base. So we're gonna now put our schedule up like this. So I'm gonna have the carrying amount here. I'll have the tax base here. I'll have the temporary difference here. And then I'll have the deferred tax here. All right. Have the deferred tax here in the last column. Now, there is something I didn't give in the question and in my illustration, MB. Let's take the tax rate to be what? 20%. You see the tax rate is 20%. So let's see what we got. So in the year one, we have 2 years coming up. What are the carrying amounts respectively as we worked out? 9,000 and 8,000. And then 8,000. For the tax base from our workings too, we got 7,500. And then what else we got? 5,625. So the difference between the two gives us the temporary difference. So that's going to be 1,005 here. You can see it's positive. That means it is a taxable temporary difference. And then the second one, 8,000 minus 5,625. That is 2,375. Also a taxable temporary difference. So to get my deferred tax, the deferred tax is going to be the temporary difference multiplied by the tax rate. Okay, the deferred tax is the temporary difference multiplied by the tax rate. In this case, our tax rate is 20% from the illustration that we brought up. So 1,500 times 0.2, it's 300 here. And then we're going to be having the second one, 2,375 times 0.2, that's 475. So this is the idea about the deferred tax. But how do we express this in the financial statements? So in the financial statement, let's say the statement of financial or statement of profit or loss, just an extract. So in the statement of profit or loss, we're going to have, let's present it in a columnar form. That means year one and then year two, slashing our currency sign. We're going to bring in the depreciation for every year from the workings one. That's 1,000 each year. Then we're going to have the deferred tax coming in. Please stay with me carefully. That's from workings 2. The deferred tax is coming in from workings 3. Now, the first year is 300. You bring that up. But in subsequent year, we don't bring the 475 in the P&L account. We rather deal with movement in deferred tax. So in subsequent years, it is movement in deferred tax that will go to the P&L account. Note also that there are some times where movement in deferred tax will go to the OCI. That is if the deferred tax is arising as a result of revaluation of assets, then the deferred tax may be recognized in the other comprehensive income. But if the question is quiet, then our deferred tax will definitely be recognized in the P&L account. So in the second year, we're going to look for movement in deferred tax, meaning the difference between the opening and the closing. So for year two, what is going to the P&L account? So balance brought forward will be the 300. Balance brought down will be the 475. So if you check it up, there is a movement of an increment of 175. That 175 is what will go to the P&L account for year two, the movement. So on subsequent year, it's the movement in deferred tax that will go to the P&L account. Like I said, that movement in deferred tax, if assuming it came as a result of revaluation of assets, a portion of that will go to OCI, other comprehensive income, then the rest will go to the P&L account. And that is, we will look at something like that maybe later on when we look at a couple of questions. Then certainly in the statement of financial position, also in a columnar form, year one and year two, slashing the currency sign coming in. We have the non-current assets. Then we're going to have the assets that we bought from workings one, 9,000 here, 8,000 here, as they are carrying amount respectively. Then under liability, deferred tax is a non-current liability item. So we bring in the closing balances. It is the closing balance that comes to the statement of financial position. Year one is 300. And then year two is 475. So realize that in the year two, in the statement of financial position, yes, the closing balance will be brought 475, but what comes to the P&L will only be the movement between the what was at the beginning of the year and what we calculated at the reporting date. And that is the idea about, deferred tax. Like I said, it has other implications. What I just look out for here is one, it has other implication in relation to revaluation of assets. Okay, like I said, if you revalue assets and there is deferred tax, it's likely that the deferred tax will be splitted between OCI and P&L. The amount that goes to the OCI should be equivalent to the revaluation surplus. there based on the tax rate. Then deferred tax can also arise as a result of even investment in associates, or let me put it, investment in general. Then deferred tax can also arise when we are dealing with share-based payments, and that is IFRS, you know, 2, and other issues in that case. But generally, what we are doing is we are comparing how the entity is carrying the item in its books and then the tax base on it for tax purposes. That is the idea about deferred tax. Any other questions for me? Any other questions for me? You put it in the chat for me, and then I'll be able to provide you with some answers in that case. So let's see, what do I have again? Precious Akpene said, please, under IFRS 16, can you give a further explanation on the treatment of interest paid in arrears and advance in the statement of financial position? I don't get a context of your statement, because on the treatment of interest paid, when we are dealing with leases, it is the effective interest rates that goes to the P&L account. So if we say interest paid in the statement of financial position, there is nothing about interest paid that goes to statement of financial position under leases. So like I said, maybe I'm not getting the context of your question well, to be able to articulate my answer. But when we are dealing with leases, whether we are making payment in advance or making payment in arrears, the effective interest is what we recognize in the P&L account. Then certainly the carrying amount will be recognized on the face of the statement of financial position, and that will be splitted between current and non-current at the end of the day. So maybe, I don't know what you're saying, there is no interest treatment in the statement of financial position. Interest, effective interest charge, is what goes to the P&L account. There is no issue about interest that will go to statement of financial position. It's only when the interest that we are supposed to pay, um it's not paid generally at the end of the day, which is rare, because if the lease is outstanding, then definitely we should have paid it generally at the end of the day. So I don't get a context of your statement, because it's error when you say interest paid in statement of financial position. It's not done. Leases, there's nothing like that. It's the effective interest rate that goes to the P&L account. Okome Felix said, good evening, please help to deliberate on fixed asset schedule. I don't know what you mean by that. What is fixed asset schedule? What is fixed asset schedule? Felix, I don't know what you're trying to say there. So what is fixed asset schedule? I don't know what you mean by that. All right, so Edward Enum, Paul Kamasha, Ba Alhaji, thank you for the thumbs up on Facebook. Really appreciate it. It helps us a lot to get a video recommended. Osmanu said, hi, Nhyira. Hello, Osmanu. I hope you're doing well and everything is well with you. Edward Enum said, great job. Thank you, Edward. Any other questions for me? Put it in the chat. Uh, and let me see if I can provide you with some answers generally at the end of the day. Like I said, we're looking at the IFRSs, and then there was a question that came up, and that was why I took the deferred tax situation to talk about it per a request. So the IFRS 16, I think, Precious, you can give more context in your statement, and then we can give a better answer generally at the end of the day. Now, so the accounting standards very crucial to be able to pass the exams. And then Okome Felix, I don't know what you mean by the fixed asset schedule. Like I said earlier, you could give us more, you could give me more. What do you mean by fixed asset schedule? I don't understand that. So another fundamental accounting standard that you have to be mindful of is this guy, IFRS 9, financial instruments. One of the sweetest accounting standards that you must understand, because it's really very simple standard, only that people, you know, are not able to wrap their head around it. Generally, financial instrument it's created when on one side a party, so there are two parties to a financial instrument transaction. There is party A and there is party B. So on one end, one party will be recognizing a financial asset, okay? Then another party will be recognizing a financial liability or an equity instrument. Sounds good? So like two parties. One will be recognized financial assets, one will be recognized financial liability or equity instrument. Now, when do we say this is a financial asset? We say it's a financial asset if we hear things like, oh, the entity bought, the entity purchased, okay, bought, purchased, or acquired. All right, but we hear of liability of or equity when we hear things like, oh, the entity sold. Okay, the entity sold, the entity issued. Okay, the entity sold, the entity issued. All right, that is the idea about that. Or the entity raised finance, that kind of thing. So it's about your choice, it's about the choice of words. Any financial instrument question you see these words coming in there. And you have to be mindful in whose books you are, because that is what will guide you as to whether you are dealing with a financial asset or a financial liability or equity. So meaning that the party B can either recognize an equity instrument or a liability instrument, can recognize equity or a liability. When can the party recognize an equity or liability instrument? We ask a golden rule question. And the golden rule question is, does the entity have an obligation to repay or redeem the debt? To repay? Does the entity have an obligation to repay? If the entity has an obligation to repay, then it's a liability. So yes, it's a liability. If the entity have no obligation, no, then it's an equity instrument. So the party B deciding whether to recognize a financial liability or an equity instrument depends on that golden rule question that we are going to be asking ourselves. Once we establish that golden rule question, boom, we can then go ahead and do the recognition. Then the party B in question can also issue what we call a convertible loan note. Okay, can also issue what we call convertible loan notes. Now, when convertible loan notes are issued, as per IAS 32, financial instrument presentation, it has to be treated as a compound financial instrument. So we have to recognize both an equity element and a debt element. But that is going to be also in the party B. That is, if the party issued or sold or raised finance by issuing convertible loan notes, raised finance by issuing a convertible loan note. So the question then is, let's start from the perspective of the party A, who is buying, who is purchasing, who is acquiring the financial instrument. It could be shares, it could be bond that they are buying, or whatever it is that they are buying. So if it's a financial asset, the question we ask ourselves is, what is the treatment generally? The way financial asset is dealt with depends on the objective of the company for the acquisition of the financial assets. Usually, if the financial assets they are buying, they want to use it for trading purposes. Okay, trading purposes, meaning that they are buying it to make some gain and go away, or they want to, not for trading purposes, but as part of long-term strategy generally of the at the end of the day, or the entity want to hold to maturity so they can get the money coming in every year from the instrument that they have bought. So these are the two options available. Why is this important? Because if this for trading purposes, it means that the transaction cost that is incurred, any transaction cost incurred is written off in the P&L account. Okay, it's recognized in the profit or loss account. Okay, then after that, on subsequent measurements, any fair value gain or loss is recognized in a P&L account. Any fair value gain or loss is recognized in the P&L account, in the profit or loss. That is the idea about if we are buying the shares for trading purposes, or sometimes it's called for speculative purposes. Okay, speculative purposes. It means that the entity has estimated that this is just an example. Okay, maybe the entity has estimated that, all right, currently MTN shares in Ghana, it's whatever, let's say 1.25 Ghana cedi per share, but MTN is about to make an announcement, and so we expect that if they make the announcement, please, this is just an example. Okay, it's not true. I'm just using it, making an example before people go and do some things. So maybe the MTN is about to make an announcement, and we think that if they make announcement, their share price will jump by maybe 25%. So it means that we are buying the shares today, but it is for speculative purposes in that particular case. We are buying the shares today, but it is for speculative purposes at the end of the day. So in that case, transaction costs incurred in the acquisition of the shares or purchases of the shares will be recognized in the profit or loss account, and the fair value gain or loss is going to be just, also recognized in the profit or loss account. But if it is part of the entity's long-term strategy, then what's going to be happening is that the transaction cost will be included in the initial cost of the financial asset. Okay, the financial cost will be included in the initial measurement of the financial asset. You got to be careful here. So in financial asset, what then is going to happen is that we'll bring the fair value, how much we paid for the financial asset. Then you add TC, that's transaction cost, and that gives you the initial measurement in that particular case. Whether it's a debt instrument or an equity instrument, the transaction cost is added as far as the entity is acquiring that not for speculative purposes, but as part of its long-term strategy, and most importantly, or they want to hold to maturity. In that case, what then happens is that any fair value gain or loss, if it is an equity instrument, okay, because on subsequent measurements, the way it will be dealt with is whether it's an equity instrument or not. So if it is an equity instrument, all right, then fair value gain or loss, it's recognized in the OCI. Fair value gain or loss is recognized in the OCI. That's other comprehensive income. But if it is a debt instrument, on the other hand, and most debt instruments may not be traded on an active market. So if the debt instrument is not traded on an active market, then it will be carried at amortized cost. Okay, it will be carried at amortized cost. And in that way, what happens then is that the effective interest rate will be recognized as income in the P&L account. So that is the idea about, financial asset and the way you deal with it. So in the question, if the question is quiet, you may choose either of them. Just that if the question is quiet, we will assume that a company is holding on it for speculative purposes. So that is the default treatment. But really, if the question is quiet, you could go either way. It will be marked for you at the end of the day. But mostly in questions, you will have the context of whether it is something that the entity has bought as part of its long-term strategy, or it is something that the entity has bought as part of or to make some short-term gain that is for speculative purposes. And that will inform us on the way the transaction cost is going to be treated, and then on subsequent measurements, how we are going to be accounting for the instrument in question. Does that make sense? Any questions? Everybody good on that? That's the idea about that. On the financial liability situation, it's pretty simple. on financial liability situation, that is, if the company is the one issuing, okay, the company is the one selling, the company is the one, receiving the money at the end of the day, then what is going to be happening is that the financial liability FL is recognized at fair value, is recognized at fair value less transaction cost. So if somebody asks, Nhyira, the transaction cost, no, when do we less it? When do we add it? If you ask that question, it means you've not opened your brain up to understand financial instruments. If it is a financial asset, meaning the company bought, and it is a financial asset that they are holding on as part of a long-term strategy, they want to hold to maturity, then the transaction cost will be added in arriving at the initial amount at which the financial asset should be carried on. But if it is a liability, always the financial or the transaction cost is going to be less. And that is the initial measurement. That is the initial measurement. Then on subsequent measurement, what is going to happen is that you're going to carry it at amortized cost. Okay, the financial liability is carried at amortized cost, and any finance cost will be recognized in the profit or loss account. It's carried at amortized cost. So Nhyira, when do I subtract financial liability? When do I subtract add financial? Sorry, when do I subtract transaction cost? When do I add transaction cost? It is the context of what you are dealing with. If it is an asset, financial asset, and the company bought it for trading purposes, for speculative purposes, then the transaction cost will be written off in the P&L account. But if the entity bought the financial asset or the financial instrument and they want to hold on it to maturity, they want to hold on it as part of their long-term strategy, then the transaction cost will be included, will be added in the initial measurement of that particular instrument that they have just purchased. However, if it is a financial liability, as far as there's a transaction cost, it will be subtracted from the fair value of the financial liability and the carrying that will give us the initial measurement. Then on subsequent measurement, we'll carry it at amortized cost, and we will calculate any effective interest rate, and that will be finance cost in the P&L. But remember, in a financial asset environment, if we are applying amortized cost, we will have a finance income, because here we bought an asset. So here there will be finance income. That is the idea generally, and the key principles that you have to pay attention to when it comes to dealing with financial instruments. I see some follow-up questions coming up. Let's see if I can take them real quick. What do we have? So let's see. Precious said, please, how is the finance cost treated under IFRS 16 when the lease payment is either in arrears or in advance? Oh goodness, I still don't get the context of your statements, because if you're dealing with finance costs, it's a P&L item. I've said this already. Whether we are making payments in arrears or making payments in advance, the effective interest rate implicit on the lease, it's a P&L item. So whether you are making payments in advance, making payments in arrears, that's a P&L item. So I really don't get the concept about how is finance cost treated. It's a P&L item. It's a P&L item. So whether we are making payment in advance, making payment in arrears, the finance cost arising from lease, it's a P&L item. And we use the interest rate implicit in the lease to calculate that particular figure. So whether we are making payment in advance, making payment in arrears, finance cost is a P&L item. So like I said, I don't know what you're trying to ask. But if it is about treatment of finance cost, it's a P&L item. Whether we are making payment in advance, making payment in arrears, finance cost is an expenses and must be written off in the P&L item. That's the idea. Must be written off in the P&L item. Kelvin Kwama said, finally, I catch you live from Lusaka, Zambia. Right. Thanks for joining us on the stream. Okume Felix said, this is interesting. God bless you richly. Right. Safia Sani said, hi, Nhyira, joining you from Chamale. All right, Safia Sani, thanks for joining us on the stream today. Any other questions for me? Any other questions for me that you would want me to share my thoughts on, basically, so that we can look at it as well? So that is the issue in relation to the IFRS, 9 financial instrument situation. Then we go to, the issue of convertible loan notes. But these are the principles. And the secret is that, and I've said this over and over again, the secret of understanding the accounting standard is, knowing about the principles, like I've stated here, relating to IFRS 9 and IAS 12 from the question that was asked earlier. That's the deal. I don't care how many questions you solve. If you don't understand the principle, you can solve 7 billion questions. You will still go to the exam hall and fail generally at the end of the day. So it's about understanding the principles. So if you don't pay attention to understand the principles relating to each of the standards, then you definitely will not be able to go in there and ultimately pass the examination. So that's the secret. So yes, I understand there are a lot of standards, but also the beauty of the standards is that they must be learned together. Okay. And this is how interesting the standard is. So let's say you start your journey from IAS 16, property, plant, and equipment. For every standard you pick, there is what we call the initial measurement and then subsequent measurement. Okay, so if we are dealing with IAS 16, initial measurement and then subsequent measurement. The beauty of the accounting standards is that most of them are interrelated, so you don't read or learn them in isolation. So whilst we are dealing with IAS 16 initial measurement, there are a couple of standards that will come to mind. The first one is IAS 23, borrowing cost. The second one is IAS 37, provisions, contingent liabilities, contingent assets. The third one is IAS 20, government grants. So at the initial recognition of property, plant, and equipment, these three standards will come to town. So you have to learn them together. You have to go with them so you don't put the principle away. They are together. On subsequent measurements, we have IAS 36 coming in because assets are going to be suffering impairment. We have to test for impairment and know the way we account for impairment. Not only that, assets are going to be revalued, and when we revalue assets, there must be deferred tax implication. So IAS 12 will come to town here so you can deal with a deferred tax implication on subsequent measurements of property, plants, and equipment. Not only that, as you're talking about issues relating to impairment, it's important to bring up IAS 38, intangible assets, because it will help you to understand. And then the principles you will discuss under IAS and the initial measurement will be applicable to IAS 38 as well. Then you can talk about IFRS 5, transfers on subsequent measurements, because we can change a property, plant, and equipment into a non-current asset held for sale. What are the principles around it? And that is the idea. Even in subsequent measurement, we can decide to change the depreciation method or the economic useful life. And that is accounting policies, changes in accounting estimates, and errors, IAS 8. So the issue is that you have to really take time to understand these very well. And that's how you learn the standards together. That's how you learn the standards together. That's the deal. That's the deal. You learn the standards together in this particular manner. Once you learn the standards together in this particular manner, all other things being equal, you will be able to understand it, and then boom, go in there and then pass the exams. So, irrespective of the number of questions you are solving, if you get the principles, you're good to go. You're good to go. And that's the relationship. So really, when people say, "Oh, Shira, the accounting standard," so even when I read a question, I don't even know the accounting standard is this. That means you don't understand the standards. Anybody that's watching this video, that you've gone through the standards, but then if you pick a question and you read a question, you don't even know the standards that is there, or you don't even know how to approach the question, you have to stop and go back and learn the standards. Because if you really understand the standards, you understand the rules, you understand the principles, you pay attention and be a student of the standard, then when you see a question, you know ultimately that, okay, by virtue of this statement, this is the standard. By virtue of that statement, this is the standard. So there are some of you, you pick a question and you're like, what is this? You don't even know. Stop the question solving and go back and go and learn the standards. That's the deal there. Samba Taylor Kamara said, "Hi, Emmanuel joining. Hi, Emmanuel joining you from Sierra Leone. Thank you, Emmanuel, for joining us." Tankoba Caesar said, "Good evening, sir. Watching live. All right. Thanks for joining us." Nicholas Samwini said, "Good evening, sir. Please kindly touch on IFRS 2 and what exactly in IFRS 2, what exactly in IFRS IAS 19. These are, complete standards that I would have to, do a class on. But what specific? If you give me something specific under them, maybe I can touch on them quickly. In that case, what specific it's your problem under IFRS 2 and then IAS 19 in that particular case. So that is the issue about, the accounting standards that you need to understand. Once you spend time to really know the principles, and if you are follower of my work on our YouTube channel, there is a lot of video on almost all the standards that you can watch. Or if you enroll in our full program on our portal, you get access to the entire library, and you have access to all the videos and be able to join our live sessions as well, doing assignments, performance evaluation test, mock, our executive practice question sessions, our executive revision masterclass session, and you study directly under my mentorship so that I can assist you to pass the examination. But there are a lot of content available as well in our mobile application. So in our mobile application, the Nhyira Premium app, either on the Google Play Store or the App Store, we have a lot of free videos there, exclusive. Some of the videos in the mobile application are not available on YouTube, so you may want to get it and then, just get access to some of the free videos as well, so you can study in that particular case. So that's the issue about that. I'm going to be wrapping up around here and then jump in for our public sector class in the next few minutes for our public sector students. So I'll wrap up here and I'll come back on Wednesday to be able to, continue with our discussion so that you will be able to pass the examination. Kelvin said, "What is the time there in Ghana? It's 5 or it's 17:36 GMT. 17:36 GMT. That's 5:36 p.m. I think so. Right. So that's it about that. Thank you for joining me on the stream today, and I'm going to be coming your way on Wednesday. And you can follow us on our social media platform and then leave comments on various posts relating to the things that you would want me to share on the stream, so that when I come, I will be able to, structure myself out generally, and then we can deal with some question in that particular case. Is there a way to understand the standard well? Because I think the issue is the understanding, because I will solve questions and I will know and understand, but after meeting another question new, that's new question, it's a problem. You don't understand the standard. There is only one way to understand the standard, and that is to learn it with a conscious mind, like I explained here. You saw the way I explained the IFRS 9. It's about principles. So the only way to understand the standards is to learn it with a conscious mind. And that means that when you are learning, you need to create a good environment for learning. It's very important, because if you are studying and at the same time you're on your phone because you got a chime and something comes up, someone sends you something and you're looking at it, you're not learning, you're not focused. So you will solve one question, you're like, ooh, ooh, ooh. But you see another question and boom. That means you don't know the standard. So the only way to learn the standard is to study it. There's a difference between studying and learning. You have to study the standards, meaning sit down, focus, pay attention, no bullshits, and you learn the principles. Because each standard, it's a principle. That's the only way out. I wish I can tell you, oh, you can put the book down and then, do some things, do something, and then voila. There is nothing like that. The only way is to make sure that you optimize your brain and be able to study at the time that you have, a great time. And so I've shared a lot on this. You can check on our how to channel, on our how to, playlist in relation to some of these items generally that I spoke about. You must have a great environment. Okay, like I spoke about, if you're studying and your data is on, Akosia is sending you a message, Amma is sending you Valentine message, and Yaya is sending you a message, Bra Kofi is sending you some emoji, and Nanama is sending you something foolish to watch, and you say you are learning, that's not learning, that's distraction. Okay, so it's about having a serene environment, studying at your peak time, and then sometimes going over and over again. Then you have to know your study style as well. Some of you learn by listening, or you learn by visualizing, that is watching a video, watching an illustration, or you study by repeating the thing over and over again. You need to identify which study style really works for you at the end of the day. So if it means that, like, let me show you something here. If it means that, if you look at what I did here in the IFRS 19, the financial assets, this is the principle about financial assets. So if it means that writing these principles on a flashcard and then maybe pasting it on your bed in your room somewhere, like, so that you will see it and then it will occur to you, maybe that's how you study. Go for it. Maybe yours is listening to the thing over and over again, so you can get the audio and then you are listening. So as you are in a vehicle on your way to work, you are in the gym, or you are whatever, doing something, washing or doing something, you are listening to it. And the more you do that, the more it is repeated, the more your brain says, this information is a valuable information. Let's keep it this way. Let's keep it somewhere important, so that when you are solving a question, the principle can be called on. So the only way to understand the standards is to study the standard. And the only way you can study the standard is to know who you are and the style of studying that works best for you. But most importantly, make sure you study when your brain is not stressed, when you're not emotionally tortured. And this goes to everybody. I'm not talking to only a kuful. It goes to everybody. Because if you're studying and you're thinking about your light bill, your water bill, you're thinking about your girlfriend or your boyfriend, you're thinking about some broken heart, some message that you receive, you're thinking about the economy, you're thinking about your pension, your brain is not there. You are wasting time. Close the book, bath, and sleep. That's it. Because one of the queries that I get also is that Nhyira, I learn, oh, I will learn and learn and learn and learn and learn. When I get up, I can't remember anything. You are not studying. You just open the book down and you are flexing. You are deceiving yourself. You are learning, but you are not studying. You're not studying, because if you are behind the book and you don't have a serene environment, you are behind the book and you are not studying, you are wasting time. You're not studying, you're just having fun. So it is important you understand how some of these things work generally, so that you go away with that. So that's what I would say. You need to study. All right, study. And that is why I always say attend the lectures. Don't do this IC on your. I don't care. You've written the paper 17 times. I don't care. You have to attend lectures. Because it depends on where you attend the lectures. But our end, for instance, you will be taken through the syllabus the way you have to understand the syllabus. And assignments will be given, performance evaluation tests will be done, mock will be done, you will be held accountable. So maybe you've written the paper 17 times, but that doesn't mean you know. It means you don't know. You are doing something wrong. So if you attend the best tuition center, then you'll be able to be provided with a blueprint. So you don't do it on your own. Some people can learn on their own and pass. Majority of the people, 99.9% of you really need a guide. You really need someone to hold you accountable. You really need someone to look you in the face and say, hey, listen, what you're doing, you will fail. So you can reason and be serious. So that's it about that. I'm going to wrap up here. And God willing, Wednesday, I'll come your way with another session as we try to, wrap up for the March 2023 examination. And like I said, make sure you attend lectures, make sure you study hard, and I'll catch you on Wednesday as we continue with our discussion. Stay safe and stay blessed.